While everyone is focused on the war in the Middle East, I just bought these 3 Israeli stocks that I will share with you today. I will explain you what each of these companies do and show you what kind of returns I expect from them. Now, the Middle East has always been a powder keg. For thousands of years, that region has been plagued by wars, and today is no different. And as everybody knows, the current fight started first between Hamas and Israel, but ended up spreading through the region and involving other players like Iran, Hezbollah, and even a distant gang in Yemen called the Houthis. What no one tells you is that this conflict has brought us a huge opportunity. And this is kind of strange to say. It seems like morally wrong, but it's true. You see, because of the war Israel is in, most people don't want to touch in Israeli stocks. But I do, because it's in situations like this that dollars are sold for pennies. As everybody's focused on the war, most are not seeing that there are many great Israeli stocks just abandoned, trading for very cheap prices, for very cheap valuations. And many of them actually have global operations, not relying that much on Israel. So that's why I started looking into Israeli stocks. And let me tell you, some of the stocks I will show you today can easily double. Now, before we start our quick but complete analysis, just reminding you that nothing in this channel is investment advice, okay? I'm just sharing my studies with you. So the first stock I bought is a technology company that solves a big problem in today's world, which is e-commerce fraud. Its name is Riskified and its shares trade on the New York Stock Exchange, ticker symbol RSKD. And since its peak in 2021, this stock has dropped around 90%, as we can see here in this chart. But honestly, as we will see, I think it will recover. That's why I bought some shares at this price here, at $4.64. But before we start talking about Riskified's upside, let's understand better what this company does and why its product is important. As I've told you, Riskified helps reduce e-commerce fraud using machine learning and artificial intelligence. So, let's say you are an online seller running an e-commerce store. Let's say you sell laptops, which are high-ticket items. How do you know if a purchase isn't a fraud, isn't a scam? Well, you need to figure this out because if a purchase is indeed a fraud, you will end up giving away the laptop and in the end, you will take the loss. That's why it's crucial to identify which purchases are fake. So in the end, Riskified helps online sellers solve this problem, thus improving their efficiency and profitability. And though Riskified is an Israel-based company, it operates as a global business. As shown here, Riskified's revenue comes from all over the world, with the largest portion from the US, followed by Europe and the Middle East. And these are the main industries Riskified serves. So, in first place, we have fashion and luxury goods, followed by tickets and travel. And as far as I've researched, people like Riskified products a lot. And I've actually included some clients' reviews in the 10-page report I wrote about the stock, which you will find completely for free in my website, Capital Ledge Research, link in the description. But as we see here, Riskified has some pretty big clients, like Prada, Dolce & Gabbana, Booking.com, and Acer. Now, it's no use having a great product or a great idea if at the end of the day, your operation cannot make money. So now I'm going to quickly show you 5 key points for us to better understand this company, and then I will explain you why I believe this stock may have a 150% upside from where I bought it. Now, for those who only look at price charts and ignore fundamentals, it might seem like this company is a complete failure. But that's definitely not the case. First, because over the last years, Riskified has been delivering steady revenue growth. As we can see here, their revenue has been climbing every year, going from 130.6 million in 2019 to 318 million today, which represents an average annual growth of 20%. And keep that number in mind because it will be important for our valuation in just a bit. Secondly, let's talk about Riskified's margins and cash flows, starting with the company's gross margin. As you can see here, Riskified's gross margin is pretty consistent, staying around 51 to 55%, which I would say is pretty solid. On the flip side though, Riskified isn't profitable yet. As you can see, this company has been only reporting operating losses over the years, which, well, isn't great. But here, it's important to understand that a big chunk of these expenses aren't actually cash expenses. In other words, a lot of this wasn't money leaving the company's account. Here we have Riskified's cash flow statement. And what's the logic here? Well, you start with the net income, or in this case, loss, and add back everything that didn't affect cash. So as we can see here, even though Riskified isn't turning an operating profit yet, they are indeed generating cash, and that's far the most important. If in 2022 they were burning $26.3 million in cash, now they are delivering $36.4 million in operating cash flow, which is a huge improvement. And since this is a capital light and highly scalable business, they don't need to reinvest much in expansion. So as we can see here, their capex is pretty low, which means that most of the operating cash flow ends up as free cash flow. And why is free cash flow so important? Because it's what the company uses to pay off debt, dividends, and to buy back shares. And speaking of buybacks, this is our third key point. So, according to Seeking Alpha, over the last 12 months, Riskified repurchased $130 million worth of its own stock. And now, in the third quarter, the company has just announced that it will buy an additional $75 million in its own shares again, which is almost 10% of its current market cap. And why does that matter? Because no one knows a company better than itself. So, when a company decides to buy back its own shares, it's a sign that it believes its own stock is undervalued. So, in a way, this acts as a buy signal. And again, let me remind you that nothing in this video is investment advice, okay? Now, our fourth key point is Riskified's high insider ownership. According to Seeking Alpha, 17.3% of the total shares are owned by insiders. And I find this relevant because I want to invest in a company whose management has skin in the game. Because if the management team owns the company, they will have more incentives to ensure it performs in the best possible way. Now, before we talk about the stock's upside and dive into its valuation, let's check our last key point, which is their balance sheet. As you see here, Riskified has nearly $400 million in cash and only about $30 million in debt. So in other words, Riskified has around $360 million in net cash. Keep that in mind. So now that we have a better understanding of this company, let's think about its valuation. So first, let's go back to that number, to the $360 million in cash Riskified has. But think about it. Riskified's current market cap is about $800 million. But by buying this company, you are also getting around $360 million in net cash. This means that the enterprise value of this company is only around $440 million. So you are paying $440 million for a company that is already generating almost $40 million on operating cash flow. In other words, you would be paying around 12 times enterprise value to operating cash flow. Well, for me personally, this doesn't seem expensive, even because I believe that Riskified will continue growing and expanding its cash flow margins. You are also paying $440 for a company with revenues of $320, and these revenues have good quality. I mean, great gross margin, super scalable business in a segment that is poised to grow with the wind on its back, right? So that's why this stock doesn't seem expensive to me. Actually, in good market times, businesses like this tend to trade at extremely high multiples, as we see here. Riskified, for example, at the peak of the 2021 bubble, reached an impressive multiple of 17 times revenue. Today, though, Riskified is trading at only around 2.6 times revenue. Now, let's try to measure if this stock is cheap. Let's go to Excel, and there we are going to calculate the fair price of the stock using a multiple projection. which is a method I fully explained in this video here. As we've seen, since 2019, Riskified has been growing at 20% per year on average. But let's assume here in our projection that Riskified will grow at 12% per year, which is well below their average. Plus, as we've seen, Riskified has already traded at 17 times revenue, but today it is trading at only 2.6 times. So let's say that in 10 years, this stock will end up trading at 5 times revenue. So with these assumptions, the fair price for this stock in the future should be $30.70. For me, having bought this stock at $4.64, this would represent a total upside of 560%. Or 20% per year. But we can think about it differently. If we bring this price to present value, using 10% as our discount rate, we will find a fair price today of about $11.80, which would lead me to a 150% upside, as I've said in the beginning of this video. So this stock would still need to go up a lot in the short term. Oh, and by the way, if you want to play with the numbers by yourself using this Excel sheet, I will leave its link in this video's description. You just have to download it. But that's why I believe this stock is cheap, because even starting from conservative assumptions, we still can find a great upside. On top of that, the company itself is loading up on its own shares, and half of its market cap is sitting in cash. And finally, this is a fantastic business. I mean, super scalable, solving a big problem with good margins. So that's why I bought the stock. Our second stock today has also suffered a lot over the past few years. As we can see here in this chart, since its all-time high in 2021, it has dropped around 90%. However, this is another name that in the long run will likely recover in my view. But before I review its name, if you are enjoying this content, don't forget to leave your like, and I also invite you to subscribe. Anyway, this stock is called Fiverr and it trades on Nasdaq, ticker symbol FVRR. But what exactly does Fiverr do? Fiverr is one of the largest freelance marketplaces in the world. So let's say you need someone to edit your videos. Well, you can go on Fiverr and there you'll find tons of people offering their services. Then you just pick the professional you like the most and well, that's it. And I think that Fiverr has a huge market ahead of itself. You see, the world of work is changing massively, and hiring people on demand is making more and more sense each passing day. Even companies are using Fiverr for that, to hire people on demand. So in my view, Fiverr is poised to ride this wave of transformation in the job market. But according to the company, the freelance or independent worker market is huge, with an estimated size of about $250 billion only in the US. On top of that, as we can see here, the freelance market is still very under-digitalized. It's still old school, with only a small portion being done online. So it seems like Fiverr has a lot of room to grow. Even with other players in the sector, like Upwork, the pie is still big enough for everyone to take a bite. So this is the market Fiverr operates in. And I bought some Fiverr shares at this price here, at $30.44. And my expectation is that I will be able to make more than 100% here, as I will show you soon. But before we talk about Fiverr's potential, let's take a look at how the company is doing financially. So starting with revenue, we've got a lot of growth here, with revenue going from 52 million in 2017 to the current 380 million. That's a total growth of 630% or 32.8% per year on average. And again, keep that number in mind. On top of that, Fiverr has an incredible gross margin of over 80%. That's really impressive. However, the company has been posting losses every single year, as we can see here. That said, the company has been getting closer and closer to achieving operational profit. But as we can see here, Fiverr has been generating a lot of cash. For example, in the last 12 months, Fiverr generated 80 million in operating cash flow. And again, since capex is low, most of that operating cash flow gets converted into free cash flow. And just like Riskified, this company has been making significant stock buybacks, as we can see here, taking advantage of its heavily discounted share price. Now, talking about Fiverr's balance sheet, Fiverr has debt. As we can see here, they have 457 million in long-term debt. However, in my view, this isn't a problem, since Fiverr has more than enough cash and short-term investments to cover its debt. And finally, in Fiverr, we also have a high insider ownership. As we can see here, according to Seeking Alpha, insiders own about 13.9% of the company. And by the way, if you're into stock research, check out Seeking Alpha, which is the research platform I use, whose link I left in the description of this video. So to sum it up, we've got a great company here in my opinion. But hey, not every great company is also a great investment, right? So now it's time to talk about Fiverr's valuation. We'll use revenue again to evaluate the stock, but for the next stock, we'll try a different method. But as you can see here, Fiverr has already traded at 50 times revenue. Now, obviously, we are not going to project a multiple like that, right? But this gives us an idea of how the market sometimes prices this type of company. Now, let's finally move to our projection, and we will start with the conservative scenario. So, as we've seen, Fiverr has been growing at an average rate of 33% per year. However, in our projection, we will consider 9%. Now, currently, Fiverr is trading at around 3 times its revenue. So let's say that in the future, we see this multiple rise to 5 times. And I don't think this is a high multiple at all. Quite the contrary, actually. But based on these assumptions, we would arrive at a total upside of 234% or 16.3% per year. But as I said, this is our conservative scenario. Now let's see what would happen with Fiverr with more aggressive assumptions. So let's consider an average growth rate of 13% per year, and let's assume a multiple of 7 times revenue in the future. Yes, I know it's a high multiple, but it's far from being unimaginable. And we've already seen that this company has already traded at much higher multiples than this. So based on these assumptions, on these premises, our total upside in 10 years would be 524%, or 25.7% per year. Now, bringing this price to present value using 10% as our discount rate, we would find a fair price today of $88.62, which would represent a total upside in the short term of 191.1%. And again, if you want to experiment with the spreadsheet, I will leave its link in this video's description. You just have to download it. Just don't forget to leave your like, okay? Thanks. Anyway, that's why I bought Fiverr, because it's a great business that is already generating cash with excellent prospects ahead of itself, and because I think this company is being priced at expectations that may be exceeded by a good margin. And now, finally, our last Israeli stock of the day. It was founded in 1993, and just like the previous stocks, this one has also been hammered by the market, falling 75% from its all-time high. But again, I don't think it will remain at these low prices forever. And that's why I bought this stock at this price here, at $80.85. I bought around $300. And as I will show you, I think that from where I bought the stock, we may be talking about a 50% upside at least. But what does this company do exactly? Well, it basically offers solutions and services for the telecommunications sector. But before revealing the name of our last stock, let me share with you a quick announcement. Soon I will be posting other investment theses, updates on my positions, and more on my website, Capital Edge Research. And a lot of content will come out there first because, well, it's much quicker to write an article than to record and edit an entire video. So if you want to stay updated, I highly recommend you to sign up on my website. But okay, now it's time for the big reveal. The name of our last stock is AudioCodes, and it trades on Nasdaq, ticker symbol AUDC. Now, I won't get into details here because there's a lot of technicals, but in summary, AudioCodes offers a wide range of solutions to facilitate voice communication in the virtual environment and is integrated with major platforms like Microsoft Teams and Zoom, which are important sales funnels for its products. And unlike the previous stocks, you could say that AudioCodes, while still a small cap with only around $207 million of market cap, is already a more mature company. And I say that because, as we can see here, AudioCodes has been delivering net profits every single year. The company has also been delivering positive operating cash flow every year since 2014, with a current margin of 12%. And since its capex has always remained below its operating cash flow, we can say that this company has consistently generated free cash flow. On the other hand, this company hasn't shown much growth in recent years, averaging only 7% growth per year since 2016. However, just because a company isn't showing growth doesn't mean it doesn't have any value. Okay, but what's the fair price for AudioCodes? Is this stock cheap or expensive? Well, now it's time to talk about valuation. And this time we are going to use the discounted cash flow method, since AudioCodes has consistently been generating cash flows over the years. So first, let's project a conservative scenario. So let's assume that AudioCodes grows at 0% for the next 10 years. And let's also assume that its operating cash flow margin will stay at around 10%, which is below its average of 12%. And finally, let's estimate that 75% of all operating cash flow generated by AudioCodes is on average converted into free cash flow. So according to these assumptions, this stock is trading at fair price. But what if we project some growth? What if instead of 0, AudioCodes grows at 7% per year, matching its historical average? Well, in this case, the fair price for this stock today would be $13.70, which would give us a total upside of 54.8%. So to close this video, that's why I decided to buy AudioCodes, because I'm essentially buying a company that has delivered consistent results for over a decade, priced as if it's not going to grow at all. But I don't think this is going to be the case, because this company is going through a transformation. It is shifting to longer-term contracts and transitioning towards a model with more recurring revenue. So we might even be surprised with a higher growth than expected. Anyway, those were my 3 latest purchases, and well, that's it for today. See you next time.